What was there was a Bank of America survey where a majority, like 70% of fund managers think that inflation is going to be transitory. What you just mentioned reminded me, I think the majority are not expecting a recession until like 2024 or something hilarious. That's a hell of a runway for markets to just move higher from where we are now in 2021 to 2024 or 2023. It doesn't matter. So Frank, why is the 10-year down over 10% from the March highs?
Yeah.
When we have all this crazy data coming out? How in the world are yields continuing to come down? And there's two ways to fight inflation. I know you're a big guy on the rate hike, but like Volcker did, or Volcker, however you say that, Volcker.
Volcker.
You either raise rates or you take money out of the economy. Well, naturally, if things keep on the same pace as they are now, what expires September 6th nationwide? The unemployment extra benefits. So by definition there, you're going to have some money being taken out or at least not injected into the economy. Some states are already rushing ahead of that. A lot of that's political, getting people back to work, et cetera, et cetera. But you have a couple of movements right now that over the next course of the years, you're going to have less money being dumped into the economy. That's interesting to me. And again, the massive moves in treasuries, I don't know if you saw the long-term chart between yields and interest rates, but these things move over decades and decades. And it's wild to me how we've had all this info coming out since March when the 10-year hit about 1.7-ish, give or take. That's a huge move, Frank. 10% yields with all this kind of shoving it in our face. Either we're way too complacent and the Fed's going to pull the rug out under your feet and shock everybody, which I doubt it, just because they don't have the spine, or B, you need to focus on companies with pricing power and stronger brands going forward because everybody from Lazy Boy to Procter & Gamble and every conglomerate is raising prices, as you've talked about. Well, something's got to give, Frank. So it's either margins, a multiple in the market, or whatever. The short answer there is brace for volatility and focus on good names during sell-offs. I know that's very general, but I'd like your thoughts on inflation going up as far as pricing and consumer goods going higher, but yet yields are manageable, let's say.
Well, for the first thing, it makes sense with the survey, right, with the hedge fund managers, and it makes sense from bond fund managers where they're not seeing this inflation, and that's something that you have to take into account for. People say in the bond market, they don't say the bond market is much bigger than the stock market. However, if you look at past periods, I mean, the bond market was not really a good indicator for the credit crisis. If you're looking at 2006 and into 2007, right, it didn't give us these huge, massive warnings, right? So usually you see people most optimistic at when it's near the top. I'm not saying that, it's cause for crash, but even when you're looking at the 80s, Daniel, when you're looking at interest rates, which, peaked in 81, whatever, around, look at actually the 10 years, like 15.7, which is rising. But, in the 80s, it came down to, by 82, it came down to 11%. And then it went all the way back up again, even though, we were trying to control inflation. But is the 10-year the best measure of this? Is it the end all? I don't know. I mean, people are looking at it saying, okay, the 10-year should be a lot higher. Interest rates are going higher. This is what we're going to see. Again, it's not being priced in right now, but that's kind of the scary thing for me. It's not necessarily like, oh, if the bond's not worried about it, don't worry about it. And again, we saw certain things, credit default swaps really go through the roof. And there's just ways of seeing it, but that pretty much happened in late 2007, 2008. But when it comes to the 10-year, it's not being priced in and people don't believe it. That's what scares me because you can't afford to be wrong on this. Again, you can't be late on this. You can't say, and the fact that we are seeing inflation at a 25-year high on the main gauge that the Fed looks at that's pretty much designed not to show inflation. And I have a Fed coming out saying, hey, we're not worried. It's going to only be short-term. You can't afford it because if you think it's only going to be short-term, you're not going to do anything. And we're seeing prices get higher and higher, labor shortage, it's going to get a lot worse. And then when they decide, oh, wait, it's going to be too late. That's why you need to position yourself. The good news here, Daniel, is that when you position yourself here, what are you going to do? Buy gold, Bitcoin, I covered it earlier. But the good news is when you position yourself in these things, if you're wrong on inflation, we're still going to have inflation. Maybe it's not hyperinflation. You're still going to have a chance to get out of these things. But for me, it's almost, I won't say it's never a no-risk trade. But from a risk-adjusted basis, positioning yourself for inflation right now makes a lot of sense because these stocks should still do well as everything reopens. China's not fully reopened now. They're getting there. And so is, Europe's gonna start opening. So you're gonna see, a lot more inflation coming. These asset classes should do well. And if we don't, we'll probably see a move back to technology and technology stocks doing better, which we're kind of seeing a little bit as the 10-year is going lower. But, to answer that question, look, it's not showing. I understand that. But for me, I'm not out of the market. I'm not saying everyone get the hell out of the market. I'm just saying, look, position yourself, because I can't believe that the Fed's not addressing this and really doesn't care about this at a problem that it's very, very difficult to control. It's going to be very painful. And nobody really remembers that, because last time this happened was the 80s.
Yeah, that's a good point. And the wild card here is that whatever Powell says today, you almost, if you take them for what they say, which you should, they really think they can control it. That's the wild card here, because everybody thinks that you have, the chemistry experiment under control until it blows up. So they think they have, and they do have the tools to fight it. I mean, I would push back a little bit that they can't afford to be late. Sure you can. You can jack rates overnight just like anybody else has in history. Now, do you have the spine to do that because you're going to cause either a recession or a stock market dip? You're going to be put under tremendous amounts of pressure from the talking heads to do something to help the people. They tug at all these emotional strings. The scary thing is, though, from the individual investors, they actually believe, hey, if we see this go from transitory to longer term, we can fix it. Sure, they can, but the destruction and or volatility and or craziness that happens between, oh shit, we missed our point, to, oh, let's get this under control, is going to be dramatic. So we're, like you said, I want to try to provide some value here, but I would focus on very strong brand names with strong balance sheets. Did you see Monster got an upgrade today from somebody? And I just threw it in Capital IQ real quick. I mean, zero debt to worry about, growing earnings and revenue at double digits, 16% this year, I think 10 the next 2 years projected. But when you think about pricing power and just, keep that simple when it comes to those inflationary scares.
Everyone
and then
has
have your hedges in
right
commodities.
I mean, it has, everyone has pricing power right now. Everybody that, like, no matter what you're
say
raising
everybody.
prices for.
I mean, I think you'll see that over the next earnings.
I honestly would say everyone.
Yeah.
Because people are not looking at something saying, I'm not going to pay for that right now. They're doing a little bit in housing, a little bit. They're like, okay, let me wait. But when I see
the more that stays with you,
up,
you're going to get to the point where you have to choose between Monster and or another drink. And that's when it's going to come down to, hey, what do you want?
And what do you think the other drink is going to do? So that's what the point is. I just went to go buy a car, and it took me 2 months. I'm not going to tell a story again. You'll listen to the past couple of podcasts, but they bagged me out, and they were raising prices. They were raising their fees. They raised everything, and I had to pay it. If I didn't pay it, the guy behind me is buying that car. I'm not getting a car. I mean, so when you have nothing on the shelves, where you're seeing that kind of massive demand, where they're like, well, we're raising prices because if you're not going to buy, somebody else is going to buy, which means they have pricing power. There's very few companies I've seen right now that don't have pricing power. I mean, Disney might be one of them. They're going to try to raise prices, and I don't think people are going to be too happy because they gave away that service for free to everyone. And, the new content is big, and not spending enough on new content compared to the competitors. But most companies that I'm seeing have pricing power. I just haven't seen anyone that raised prices, and I'm not going someplace because they raise prices. They're still going.